I once did a loan, a $750,000 refinance for an 82-year-old woman on Social Security with no other income.
Was it a reverse mortgage?
How did I do that? No, it was not a reverse mortgage.
Yes,
She
yeah.
didn't want. No, it wasn't a DSCR. It was on her own.
Asset depletion.
Yes, asset depletion. So let's talk about asset depletion. Now, a lot of people have it. Mine is easier. Let me tell you why mine is easier. I was able to combine. She had $400,000 into her bank account. We combined that with her Social Security income, et cetera, et cetera. She had other. Now, asset depletion. How does it work? Asset depletion can be used. We have asset depletion you can use standalone, or you have asset depletion we can use combining it with other income. So you can combine it, Social Security income, you can combine it with full doc income, you can combine it with alt doc income, bank statements, 1099, other things, right? So we can have multiple people, some work, some don't work, some have assets, some don't. It's the thing that can bring you to the next level. So if you're concerned, and this is important to tell your realtors, because if you're out there, you're putting an offer in, you just took them to 20 properties, you put 5 offers in, we got the husband and a wife to agree on this property, we sat down for an hour deciding what contingency we wanted to put in, and we're worried that now that we get countered, and it's pushing us over the DTI a little bit, now you know you might want to go to a broker who could get you a lender like me, who can add the assets that are sitting in their bank account. Now, so how does the asset depletion work? We take their assets, they don't have to deplete them, we just show 2 months only of asset statement. Some lenders are 4 or 6, only 2. 2 months of those assets, and we divide that by 60 months. This is one way of doing it, 60 months. But here's the devils and the details. Now, if it's a retirement account, we treat it like most people do. We're going to give them, in our case, 50 to 70, or 50 in our case, only 60, but maybe we'll get you 70. 50 to 60% depending on the retirement age. But here's where we do get stronger. Now, everyone mostly says if it's checking, savings, or money market, fine, 100%. But here's the details. If it's an investment account, which a lot of it will be, because of course they're going to invest it, we give 100%, and it's crazy that we do this in this market, but we give 100% of the investment income also.
So investment income, it means, let's say your case, 400,000, she has 400,000. So what is going to be her income?
400,000?
You
has a calculator?
just use this.
You take 400,000 divided by 60. That's it.
That's a formula, basically.
Yeah.
So let's say 600,000, it's divided by 60, it's going to be 10,000 months, right?
Exactly.
This is your, yeah, correct?
Yes.
Yes.
Yeah, okay.
Exactly. But most other lenders would say you can't use that 600. You have to multiply that by 0.7 because they have a 30% expense factor if it's sitting in an investment account.
Okay, you
So
talking
that
about any money or just, but you said that if it's a IRA, if it's a 401k.
Okay, so any non-retirement income, we're going to give 100%
Okay,
of.
got it.
And
Divide by
retirement
60.
income, depending on age, we would
Yeah, okay,
have an
all right.
expense
So
factor
now it's
because they can only take out so much,
I got
right?
it, okay.
So that's a good thing. But there's another way to do it. We have another way to do it. And this is easy to explain to realtors. If you've got a person that wants to buy, as long as they can show me in their bank account the same amount of money as your loan, you qualify.
So you're buying for $1 million, you have $1 million, which you're
Qualified.
which is going to be used for the down payment?
No. The money that you have after down payment
After
reserves.
the down payment. In other
After
words,
down payment, whatever you have left over.
Yeah, then this is what you're saying.
Exactly.
Yeah, okay.
Other lenders have something similar, but they're like, we want 60 months of other debts. It's similar, but this is just a little bit more aggressive. And that may matter, it may not. But keep in mind that we're also going to be competitive on price and other guidelines. So that's great. So I thought that was interesting.